Ever notice how a small percentage change in interest rates can suddenly make a big difference in your finances? It might not seem like much, but these little numbers have a big impact on your wallet. Welcome back to the channel. Today we're talking about interest rates and what that means for your wallet. An interest rate is basically the cost of borrowing money or the reward for saving it. If you take out a mortgage, a car loan, or a student loan, you're paying interest to the lender. It's a percentage of the loan amount and a part of your monthly payment which goes towards that interest. Now, flip it around. When you deposit money in a savings account or you invest in a GIC, the bank pays you interest. That's your reward for letting them hold on to your money. So what happens when interest rates go up or down? Well, rates don't move randomly. They're influenced by things like inflation, the economy, the decisions made by the Bank of Canada, that's our central bank, and every few weeks they meet to decide whether the benchmark rate, also called the overnight rate, should go up or down or stay the same. This rate influences what your bank charges you on loans and pays you on savings. When interest rates go up, borrowing gets more expensive. Variable rate mortgages, lines of credit, and loans all cost more. But there's a silver lining. Your savings account and investments you may have also earn more. So if you've been stashing money away, rising rates could actually give your savings a nice little boost. But when rates go down, borrowing gets cheaper. It might be a good time to refinance your mortgage or lock into a fixed rate. You'll pay less in interest over time, and that can mean big savings. But the flip side is that your savings account may not earn as much, or your GICs. Now, it's important to note that our economy is to a degree intertwined with the United States of America. So what happens there economically and sometimes politically can impact us here. Interest rates also have a big effect on your investment portfolio, especially if you're planning for retirement. Rising interest rates can cause bond prices to fall, which may lower the value of a conservative portfolio. Stocks can also react negatively if companies face higher borrowing costs. On the other hand, falling interest rates can boost bond values and encourage investors to take more risk in search of better returns, which can benefit equities. Interest rates affect more than just loans and savings. They ripple through the whole economy. Higher interest rates can make it more expensive for businesses to borrow, which can push up the prices on goods and services, while lower rates can do the opposite. Cheaper financing for businesses might mean lower prices for you as a consumer. If you're close to retirement, big interest rate swings can make your portfolio more volatile than you like it to be. And if you're younger and investing for growth, lower interest rates might mean rethinking your strategy to make sure your money's still working hard enough to meet your long-term goals. So understanding interest rates isn't just about knowing what your mortgage payment will be next month. It's also about managing risk, preserving your savings, and making sure your retirement plan stays on track. Now, you might be thinking, how do you stay ahead of all this? Well, one, it starts with awareness. It starts with knowing how interest rates work, how they affect everything from your investments to your grocery bills. And all of that helps you make smarter financial choices. Now, if you want to get ahead of the next rate change, let's talk. We can help you understand how rising or falling interest rates could affect your unique situation and build you a financial plan that works for you. Interest rates don't have to be confusing or intimidating. And with the right strategy, you can make those rates actually work in your favor.